Good evening and welcome to the Money Show. I'm Kavita Thapalial and this is a show that puts your money matters front and center in a world full of financial noise. We are here to bring you clarity, confidence, control over your personal finances, whether you are planning for retirement, building a portfolio, navigating debt, or just trying to make smarter money decisions. This is your space, your guide, and your daily check-in with your wallet. Every evening, we bring you insights from top financial experts, decode the latest trends, and answer your burning questions on saving, investing, spending, and everything in between. Because here on the Money Show, we believe one thing. You don't have to be a finance expert to take charge of your money. You just need the right advice. And that is what we will do. So let's begin the show. And today we step into a zone that is bright on promises but dark on transparency. That's right, the grayest corner of our markets. The IPOs, unlisted shares, rights issue, preferential allotments, and warrants. Markets may look predictable today, but investors continue to get trapped where information is incomplete, incentivized, or skewed, and valuations defy logic. IPOs are marketed like blockbuster launches, unlisted shares trade in opaque lanes, and preferential issues quietly shift power into few hands. Now, here's the uncomfortable truth, and we will elaborate this more on the show as well. Many IPOs come at overstretched valuations with little financial history. A large part of fundraising ends up giving exits to private equity, not growth to the company. Unlisted shares carry huge liquidity and pricing risk, often ignored in the rush for pre-IPO glamour. Rights issue can reward or punish depending entirely on the discount narrative. Preferential issues and warrants create two separate classes of investors: informed insiders and hopeful outsiders. So today we break down every fundraising route, the pits, risks, and red flags. So you know exactly what you are walking into before parting with your money. And joining us today is Mr. Kishore Oswal. Before we begin, here's the guiding question for all our investors. Are you investing in growth, or are you funding someone else's exit? So let's decode the grey market of capital raising. Mr. Oswal, good evening and welcome to the Money Show. So let's begin. And let's begin with the IPOs, the hype trap, okay? Why are IPOs still priced at 30 to 50% higher PEs than listed peers, when there is no SEBI check on valuations? Isn't this simply shifting risk to uninformed retail investors? How would you like to explain this point?
I would rather explain IPO. I would break IPO into three parts.
Okay.
Some IPOs are for raising fresh equity. Some IPOs are mix of fresh equity and OFS, and some IPOs are only for OFS. The first category generally where investors can really invest, because in fresh equities, the money which is raised through IPO goes into projects and greenfield projects where promoters invest that money in projects which will generate revenues and profitability, and the earnings of the companies will improve. Now here also, in this part also, we should break into two parts. One is IPOs at a fair valuation, and one is IPO at a very excessive valuation. Anything around 16-20 price earning ratio should be very fair, provided the sector is good, provided the company is good, the profitability is good, the past history shows some good profitability, then one can apply for the IPOs. But anything above 80-100 price earning ratio, even it is for fresh equity, we should not consider it, because there are opportunities elsewhere available at 15, 10, 12 price earning ratio where you can make more money. But of late, what has happened is that IPO generally has become only a listing gain business. So people apply for IPO and try to exit within 30 minutes. And if they are lucky, they can make money. If they are not lucky, they can end up in making losses. The fresh equity is plus OFS. Again, we need to see how much is the fresh equity versus how much is the OFS. So if fresh equity component is higher, still it can be considered. And if it is OFS component is higher, then again the same question arises, which is in the case of OFS, where we are replacing shareholders. There is no growth coming to the company. We are giving exit either to the promoter or to the private equity investors. Now, the important question is why private equity and promoters are exiting through IPO. Through IPO. The reason is that they themselves are suggesting that the valuations are very expensive. So if
So, Mr.
the
Ostwal,
promoter or
exactly. So
private
we'll just keep it short. So isn't this a red flag? Why isn't this disclosed in a simple language? Because we are talking about exits, and when private equity is exiting in an IPO, this should be a red flag, right? And this should be disclosed in simple language.
For example, I can refer 3 IPOs
Sure.
like Paytm, Zomato, and Nykaa, and even that Krishna Diagnostic. In all these cases, if you look at, the money has gone to private equity and the share prices have crashed almost 60-70% in all such cases. So what we are doing is we are replacing the shareholders, but the money which is being raised, it is going to the promoter or private equity. It is not coming to the company. Company may be good. So after few years, probably when the correct valuation comes in, like Zomato 34 or Paytm 400
Right.
rupees, this becomes again a good stocks to enter because they have growth stories.
Right.
But
Of course,
not
there are
at the
great
valuation
stories.
at which the IPOs are coming.
Right. So now, just to understand, if underwriters get shares at heavy discount, does that not mean retail investors are effectively overpaying from day one? Should retail
100%.
investors even participate in aggressively priced IPOs, or is the product now suited only for listing day speculators? Two questions I know I've asked in one go, but then what is your view?
100%. Most of the investors are only trying to apply for listing gains.
Absolutely.
And they are getting stuck when the IPO gets into discount. And there is a very clear, because underwriters, they have some understanding, so they have a discount, official or unofficial also. But investors, they have no excuse. They just apply and try to exit on listing. If they can't exit, then now look at the IPO like Tata Technology. The stock got listed at 1400 and got corrected to 650. So what is the fair valuation? Nobody can imagine.
Exactly. So we can safely say that retail investors are effectively overpaying from day one. Is that right?
Absolutely, absolutely, yes.
Okay, let's talk about unlisted pre-IPO shares, which we call the dark alley as well. Isn't the biggest risk in unlisted shares the absence of price discovery? Why do investors pay, a PE of 15, 20 when the IPO may come at only 16 or 18?
No, in case of unlisted shares, only select investors are coming, maybe mostly insiders. They know everything inside out and they buy it. And those who buy it only here on say, they always make losses. For example, Tata Capital in grey market or in unlisted market, the share got traded at 1,000, 1,100 and the IPO was 320 rupees. So it's not necessary that every IPO will give you money. So unless you have a very, very strong pedigree of the promoters and you can check the history for last 4-5 years, then only you can go into unlisted markets. Secondly, any shares you buy before IPO, you have a lock-in period of 6 months.
Right.
So you don't know after 6 months what will happen.
But then let's talk about manipulation. Platforms selling unlisted shares claim booming demand also. But who regulates this pricing? Isn't this an open field for manipulation then?
There is no regulation applies. When it comes to IPO, then only SEBI verifies the document. SEBI is not an authority to check the valuation. SEBI is the authority to check the procedure. They just check whether everything is in place and the IPO qualifies for IPO or not. The exact valuation has to be certified by the merchant banker. And today everybody is in a rush to give higher valuation so that they can get some business.
Right. So, just to understand, what safeguards can investors realistically rely on when audited financials are sparse or exits are unpredictable and tax rules are also complicated? Because, if a company, for example, delays their IPO or prefers private capital again, what happens to those investors who are locked in with no liquidity?
They are stuck. They have no exit.
Yeah.
Till the time the IPO comes, they have no exit. Rather, after 6 months of IPO, they will get exit.
All right. Let's talk about rights issue, which can be a discount or maybe a trap as well. So over here, we want to understand is, rights issues are called the safest route, but promoters sometimes price rights with negligible discount, also pushing retail away. Now, should SEBI step in with minimum norms out here? What are the current norms and what's the current structure we can see?
There is no norms for rights issue. Like PTC, when the price was 5,000, they issued shares at 10 rupees. And I think the safest and most reliable mechanism for investment is supposed to be rights issue.
Okay.
Because you know what happens when rights issue is announced, promoter also invest in the rights issue. Now, if in any company promoter stake is 70%, then in the rights issue 30% general investors invest and 70% is brought by promoters only.
Mhm.
Only in few cases where promoter wants to increase their stakes through rights issue, then the pricing will be very close to market price. In that case, general investors don't apply. So when general investors don't apply, automatically the promoter stake will go up.
Hmm. All right. So let's understand this, okay? If I can buy the same share cheaper in the market, why should I subscribe to rights at all, sir?
Absolutely, that is what I said. You know,
Yeah.
they keep the price, market price, and rights issue price almost similar. In
Hmm.
that case, nobody applies. Automatically, the promoters get a oversubscription and their stake go up. But genuinely, if the rights issue is good enough, then the rights has to be at a substantial discount.
Right. Right. But then how does the retail investor identify such situations now? What can be done in these kind of cases from an investor's perspective?
Investor only has to see the rights issue price and the market price. If the difference is substantial, they have to fairly go out and subscribe the rights issue.
Got it. Got it. Preferential issues, power without transparency over here. So preferential allotments allow large investors to buy at regulated prices, okay? But does this create an uneven field for retail who can never get such quantities at such certainty? Does that mean this?
No, this preferential route, generally what happens, it is actually open for very select HNIs or institutions where they are keen to join the company in their growth trajectory. So what happens is that it's for general investor, this route is not at all available. What happens, you know, generally this happens in scripts where the liquidity is very poor. And if HNIs are looking to acquire a very big blocks or institutions are looking to acquire big blocks, then they prefer this route.
Okay, but sir, one very common question, because this is what is a trend also talking about. Why is preferential route suddenly more popular than IPOs? Is this admission that IPO valuations are too inflated?
Yes, IPO valuations are always inflated and preferential route, you know, even though on record nothing is there, but when the company approaches some HNIs or some investors or institution investors, they always present their case. Okay, what is the growth prospect in coming 2 years, 3 years, 4 years? Based on that only, investors make application in preferential allotment.
Okay, let's just move to warrants now. High risk and high leverage. Warrants allow investors to pay only 25% upfront. Isn't this effectively a leveraged bet with asymmetric risk? Should retail investors stay away entirely?
No, as I said, preferential warrants is also preferential allotment. So for retail, when preferential allotment is not available to investors, even warrants is not available to investors. Now, what happens in a promoters generally prefer preferential issue through equity shares because they get 100% upfront money. But many HNIs influence promoters say that we will get a large chunk only if you allow us to pay 25%, and so they will ask for a warrants. So what happens, you know, they get a 18 months period to evaluate the company and see the working of the company. If the company is not really doing well, then their 25% gets forfeited. Otherwise, if the company's price goes up and performance comes up, they will pay the balance 75% and up for the shares.
All right. So, in a nutshell, should
The
it
only
retail?
difference, the
Sure.
only difference between preferential issue and warrant is that shares are locked in for 6 months from the day of application. In case of warrants, first 18 months is the period for the warrant subscription. Of course, they can subscribe in after 2 days also, but 18 months is the last date. After that, again, the lock-in applies from the date of allotment.
All right. So, let's just understand this from an investor and audience point of view. Should retail investors stop chasing every fundraising event and instead wait for listed companies' proven performance? Do you think that should be the route going ahead? And, all this noise should be really cut out from?
No, retail investors don't chase preferential issues and warrants.
No, generally, in a nutshell, we are talking about
Retail
all.
investor chase the names which comes in preferential issue.
Right, right. So no, I'm
Now,
also talking about across IPOs, unlisted shares, rights issue, preferentials, and warrants. Across all of this, should investors really just quit all of this, stay away from all these fundraising events, and instead go for listed companies' proven performance?
if they are looking for a long-term investments, yes, this is the correct approach that various companies are available at, for example, you take State Bank of India, it is available at a 10 PE. Then why one should apply for a company at 80 PE? So, investor have various options available on the floor itself where they can acquire quality good stocks for long term, where they can make money 40-50% return very easily. Then listing gain is only for 5-10%, 20%. And since you are unsure what is going to happen the very next day, they will have to exit within 30 minutes.
So it's your hard-earned money, which is why it makes sense to just stay put and in good names, in trusted names, in proven performance names. Thank you so much, Mr. Oswal, for being on the show and helping our viewers break down this all the magic that they see behind all these fundraising activities and routes. Thank you so much.